A story. Every great story has a beginning. Ours began more than a century ago. A story of trust, of leadership, of always being first. And like all great stories, between 2017 and 2019, we turned a new chapter in our journey and called it Primus, from the Latin word meaning number one. This has birthed various innovations and achievements that has kept us on top. And for us, Primus is more than just a word. It's a promise to lead, to set the pace in digital banking, delivering innovation that inspires trust and builds the future. Between 2020 and 2024, we shifted gears to launch Primus 2.0, where we delivered First Direct 2.0, launched self-service kiosks, adopted robotic process automation, and opened digital experience centers across Nigeria, amongst many others. We stand at the threshold of yet another bold new chapter for 2025 to 2029, Primus X. Primus X is our mission to be the #1 financial institution in Nigeria. And X, like the Roman numeral for 10, a symbol of our ambition to rise among the top 10 banks in Africa by 2029. Is this mission possible, you might ask? Definitely. And here's how we'll make it possible. Not by resting on past achievements, but by setting new goals that align with the future we envision. We will deliver differentiated customer experience, enhance market share and profitability across core business segments to achieve industry dominance, accelerate automation and digital adoption through customer-centric designs, grow presence and scale in key strategic markets outside Nigeria, innovate into strategic platform and ecosystem adjacencies, institutionalize operational excellence and efficiency. Primus X is not just about strategy. It's about you and the demonstration of our core values: entrepreneurship, professionalism, innovation, and customer centricity. Epic. Every success will bear your fingerprint. Every milestone will echo your contribution. Because being first is our nature. Visit the Primus Hub for updates. Join the conversation on Primus Viva Engage. Primus X, leading the future together.
You first. First Bank.
Check that. Looking for a business account like no other? We are proud to introduce you to FirstSME. With FirstSME account, you get to enjoy services such as zero account maintenance charge, access to webinars and trainings, various creative facilities, access to SME Connect portal, directory promotional offers, and lots more. So, open your first SME account and start enjoying these benefits today.
You First Bank.
I'm tired, man. My brakes squeak, my engine wheezes, but my human says no money for upgrades.
Chai! I've been there. Trust me, I used to backfire mid-turn. Embarrassing stuff. But last week, my human found out about First Credit by First Bank.
First Credit?
Yup. Quick, collateral-free cash straight to his account. Boom. New brakes, fresh oil, and premium fuel. Tell your guy to wise up. You deserve better, bro.
Need urgent funds? Whether it's bills, upgrades, or emergencies, First Credit by First Bank gives you up to 300,000 naira. No paperwork, no collateral, just credit when you need it.
Dial star 894 star 11 hash or get it from your First mobile app.
First Bank makes you big.
You first. First Bank.
We all have those awkward moments when we choose the wrong time not to be with cash. There are times when nothing else would make you happier than just a little airtime. Other times, all we need is a seamless way to be sure if we got that money you've been expecting. Whatever the case, there is a 894 code for you. Just dial *894# to seamlessly transfer funds, buy airtime, check your account balance, and more with absolutely no internet required. Quick banking. So simple, so easy. You first. First Bank.
Good afternoon, everyone. I can see that the chat room is already buzzing. Good afternoon. Thank you, everyone. Thank you for signing in. We really need to nudge our colleagues and customers to join in on this profound webinar this afternoon. So many questions have been asked about the tax reforms, and this is such a wonderful opportunity for us to be learning together as a bank and as a community, because that's what we are. We want to ensure that our customers are well informed so that we all together as a community are taking the right decisions and we are also doing the right things and being good citizens. So please, let's hear some more from the chat room. If you are a customer, please let us know where you're signing in from. We'd love to know that we're touching and reaching all the 774 local governments of Nigeria. And even if you're signing in from outside the country, it would be great to know. So please, oh wow, thank you. Michael joining in from Canada. We have Lagos, we have Port Harcourt, we have Ajegunle, we have Abuja, wow. We have Katsina. It's really buzzing in here, and I know that we are all going to have a swell time. We have Ogbonna from Asaba. We have Umar from Katsina. We have Christiana from London. Thank you so much. Thank you, thank you, thank you. Please pull in your neighbors, pull in your customers for First Bank staff. Please pull in everybody to ensure that today's program is well enjoyed by all of us. Don't be the one to be told, as we're going to go right in to the, oh wow, we have the CEO in the house. Good afternoon, sir. You're welcome. Please join me to welcome the CEO, who is going to be giving us a very brief remark to open up this webinar. Let's put our hands together as we welcome our CEO, Mr. Olusegun Alebioshu, who is going to be giving us a quick remark before we dive right into the business of the day.
Thank you.
Good afternoon, sir. You're welcome.
Good afternoon.
Thank you, sir.
Thank you so much
Please
for
go right in.
introduction. The speaker for today and my colleagues. You know, tax is the most important topic today. Both to our customers, we as employees. Of course, it has always been an issue that our tax to GDP is too low. It's one of the lowest in the world. And then how on earth do you actually want to build an economy? Your tax to GDP is this low. Government came up with this, and I'm sure people are reacting. It was an opportunity for us to hear from the experts, to educate us, to enlighten us, and to guide us on how best to deal with issues like this. And so we're having this today, and I want each and every one of us to listen attentively and try to benefit from every line or every discussion point to listen and benefit. Today, I'll be 100% here just for me to savour everything from the experts. So thank you so much.
Let's dive right in as I bring the chief economist of the bank, Chinwe Ewim, to take us through the list of very awesome panelist members that we have and dive right into the discussion for today. Chinwe, please, go ahead.
Thank you so much, Tobechukwu, for that introduction. Good afternoon, distinguished clients, stakeholders, and colleagues. So my job here today is to just lay out a clear macroeconomic and fiscal perspective, one that would help connect what we are seeing in policy to what it actually means for businesses, for investors, for households. And what we are seeing at this point is a shift in how fiscal sustainability is being approached. So moving from a system that relied heavily on a few sources of revenue to one that is now being broadened over time. At a basic level, Nigeria's revenue base has not always reflected the full size of the economy. At the same time, there are demands on government across infrastructure, security, and social priorities. And these demands have continued to grow. So the implication is very straightforward. An economy of this scale does require a broader and more resilient revenue base. So what is happening now is an effort to better align how the economy works with how revenue is generated. We are seeing a stronger push to more people and businesses into the system to improve compliance and make the structure more consistent. In simple terms, I would say that the direction is from a narrow base to a wider one, and from gaps to better coverage. And that really matters, not just for governments, but for overall stability of the economy and the environment in which we all operate in. So the broader economic environment is also important. Inflation has started to ease at the headline level, and foreign exchange conditions have become relatively stable. Despite that, businesses and households are still dealing with high costs. Decisions are being made more carefully. So in essence, this is not a reset, it is a period of adjustment. Within this context, the current tax framework becomes more relevant. For businesses, the environment is becoming more structured. Compliance is no longer something handled at the end. It is becoming part of how businesses operate every day. And that means more attention to planning, to record keeping, to understanding what exactly is required. And for investors, the picture is slightly different. A more predictable and consistent system helps reduce uncertainty, and it does support long-term investment decisions as well. Capital does not just respond to returns, it also responds to confidence. And confidence is built over time when the system is consistent. So at the broader level, a stronger and more stable revenue base does give government more room to respond to shocks and support the economy when needed. Stronger revenue ultimately means more flexibility, and that helps the economy manage difficult economic cycles which come and go. So what does this mean in everyday terms? Let me bring it closer to practicality. Right now, many businesses are dealing with higher costs, tighter margins, and more pressure from all sides. Households are also feeling it. Prices are still high and planning is harder. So the natural question is, where does this leave us? What this new direction is trying to do is address a long-standing issue where too few people and businesses were carrying most of the burden. Over time, the aim is to spread that responsibility more evenly. If that happens, it does mean compliant businesses are no longer at a disadvantage simply because they are already within the system. It also means fewer surprises. Instead of unclear expectations or sudden changes, the goal is more towards a system where businesses know what is required and can actually plan around it. Now, for households, the benefit is less immediate, but it does come through the broader environment. So a more stable system does support more stable prices, fewer sharp disruptions, and a better sense of what to expect. So while the pressure is real and it is being felt, the direction is towards a system that is easier to understand, that is more predictable, and more balanced than what we have seen in the past. I think it's also useful to look at how this is being interpreted on a broader level. At its core, the current tax framework is about expanding the revenue base and improving how the system works in practice. So it also reflects the need to manage multiple priorities at the same time, such as security, such as infrastructure and social needs, while continuing to meet existing obligations. Now, recent developments show continued efforts to strengthen how revenue is collected and managed and to improve transparency around key sources. From a market perspective, fiscal policy is no longer viewed only in terms of how much is spent, but also how revenue is generated, how consistently policies are applied, and how sustainable the overall approach is. In practical terms, this is shaping how capital is allocated, and it should also help with assessing risk and how businesses plan ahead. I would say, bringing it all together, a few points are worth keeping in mind while we transition into the panel session. And the first is the environment is becoming more structured. Businesses that adapt early through better planning and compliance will be in a stronger position. Secondly, this is a period of adjustment, not a one-time change. So the impact will take time to settle across sectors. And thirdly, stability is the goal. So even if the path is not particularly straight or easy based on specific viewpoints, the direction is towards a more predictable environment for businesses and investors. And finally, flexibility will matter a whole lot. Those who stay responsive and forward-looking will be better placed to navigate this period. So this sets the context for the conversation. The next step is to bring this into practice, how these changes are being experienced, what they mean across sectors, and how businesses, clients, customers, investors are able to respond to it in real time. So I will hand over as we take the discussion forward. Thank you so much.
Thank you so much, Chinwe. Thank you so much. And we'll just move right in to bring up Chike Uzoma, who will be moderating this session. I'm sure Chike can't wait to get right into the nitty-gritties of today's discussion. Chike, please, over to you as you pilot that segment. Thank you very much.
Thank you, Tobechi, and thank you to our distinguished customers and everyone that has joined this webinar. Today, we are bringing in very, very huge experts to talk to us today, to interact with our entire customer base and all our stakeholders who have joined this webinar. We've assembled the right set of people to take us on this journey. Because for us at First Bank, we will always want our customers to be a step ahead, and being informed and knowing what to do is actually the right thing to do for our customers. So permit me to bring in our three expert panelists. The first person is Dr. Uche Owalaka. Dr. Uche Owaleke is a very, very experienced expert. He mixes both the academia with the private sector. He's held several roles across industries. Currently, he's a distinguished financial economist and a professor of capital markets with a career that spans the academia, regulation, and public service. At the moment, he is a director of the Institute of Capital Market Study at Nasarawa State University. Previously, he served as the head of Accounting and Banking and Finance Department. He's a professional experience across several roles he has also held. He used to be the chief economist and director of research at the Securities and Exchange Commission in Nigeria. He was a one-time honorable commissioner of finance in Imo State and a member of the Nigerian Stock Exchange Advisory Committee. He's a prolific author with over 70 scholarly publications, several widely referenced books. He's also a fellow of various professional institutions. One of the reasons why we had to bring him here, he was part of the experts that crafted the current Nigerian tax reform policy, the Nigerian Tax Act of 2026. So you can see why, for us at First Bank, we go for the best. And so please welcome Professor Uche Owaleke as one of our panelists. Professor Uche, you're welcome. Please, can you say hi to our customers and distinguished stakeholders?
Yeah, thank you very much. Good afternoon, everyone. The CEO, I want to say I'm delighted to be part of this conversation.
Thank you, Dr. Uche, and welcome, and thanks for honoring our invitation. I will also introduce the second panelist, Olufemi Olarinde. Olufemi Olarinde is the head Physical and Tax Reform Division of the Nigerian Revenue Services. You can see we also had to go to the reinstitution where some of the thought process, where some of the implementation actions are being done to bring in Dr. Olufemi Olarinde. He's a seasoned tax policy and administration expert. He has over 2 decades of experience across public and private sector engagement. He currently serves as the head of the Physical and Tax Reform Division at the Nigerian Revenue Services. This is the government agency that is responsible for tax in the country. He's a chartered accountant, a chartered tax associate, a chartered human resources professional. He's deeply involved in shaping national and international tax discussions. He's also a member of the UN Subcommittee on Environmental Tax. He served as a member of the Presidential Physical Tax and Reform. Right now, he's in the implementation committee that is also driving the overall implementation. He's a widely respected public speaker, and he has delivered over 30 international tax conferences events. So welcome, Mr. Olarinde Olufemi. Welcome, Olufemi. Please, can you say hi to our customers and our
Yeah, good afternoon all. Good afternoon, Professor. Good afternoon all on the call. Thank you for having me. I'm delighted to be here.
Thank you so much. Thanks for coming. I'll bring in the last of our panelists, a very erudite scholar as well as a global consultant. He is Mr. Albert Folorunsho. He's the managing director of a reputable consulting firm, Creston Padable. Today, he's a leading professional player in the professional services firm. He established his firm Padable in 1998. He has over 3 decades of experience in supporting businesses. He has a cross-functional expertise across tax, insolvency practice. He's a management consultant of great repute. He has some expertise spanning both international tax advisory, transfer pricing, oil and gas taxation, and business restructuring. You can see why we had to bring him in. He's got the expertise to guide our customers, advise our customers on some of the burning issues around tax. He's a fellow of multiple professional bodies in accounting, taxation, banking, insolvency practice. He has served on various national tax and physical reform committees, including the Presidential Committee on Physical Policy and Tax Reform. And that's why he's there. So we brought in people who are adept in this area that we're discussing. He's an international affiliate of UK Chartered Institute of Taxation and a long-standing lecturer in advanced taxation, as well as a recognized contributor to tax policy reforms across various areas in Nigeria. So welcome, Albert Folorunsho. Thank you, Albert.
Thank you very much. Let me congratulate First Bank for doing this for their customers, and I'm sure they will be very happy for this gesture from the bank. And but at the end of the day, they will see the benefit and be able to be compliant and avoid all the loopholes and the booby traps that are embedded in the tax law. Thank you so much for having me.
Thank you so much. So the 3 are my panelists today, and we'll be taking straight dive into our discussion points. So customers, please sit back and enjoy from the deep well of experience from these 3 panelists. I'll start with you, Professor Uche. Prof, I'll just ask you, at least some of these questions came from our customers and our stakeholders, and so I would like you to just enlighten them on some of the topics and issues that they have to enable them to understand the tax reform very well and how it does concern their business and how they will need to position. So the first question I will be putting to you is, I will just restress from what the customer had asked. There have been concerns around the taxation of returns on certain financial instruments, including short-term securities. How do we balance revenue generation with maintaining investor participation? Professor Uche. Prof, you may need to unmute so that our customers can hear you. You're muted.
Okay, yes. Thank you very much, Chike. And once again, let me join Albert and the others in commending First Bank for organizing this, because the implementation of the tax reforms will not succeed if there is no cooperation from the public, members of the public. So first, they need to understand that it is done in the interest of the economy, overall. So on that note, that again, First Bank deserves commendation. Now, talking about taxes on instruments, of course, you have short-term instruments and you have long-term instruments. I'm sure the person that is asking that question is concerned about the tax on returns from, say, treasury bills, commercial paper, and maybe some other instruments that also issued either by the government, the one by the government, or by the company. Let me say upfront that the good news is that today there is no tax again on any investment in state bond. So if you invest in a state bond and there is a return on it, you are no longer going to be taxed. The same with federal government bonds. So if federal government is issuing bond and you buy the bond and then there's a return on the bond, you are not going to suffer, that income will not suffer any tax. So before now, it used to be restricted to just federal government bond, but now state government bonds have also been exempted from tax. And that's talking about returns from those instruments. So that concern has been somehow taken care of. But the one that still remains is the one on treasury bills. Of course, when you buy treasury bills, you get your return upfront. Your return suffers 10% withholding tax. Okay, so that one is still there. The same with some other short-term instruments. I think maybe going forward, that there will be need to maybe have a threshold, the way we also have thresholds for people who get returns on the sale of their shares. There's a threshold now. Essentially, the law seeks to protect small investors. Okay, so if you have if you're selling your shares, you're selling your securities, and the entire value is not up to 150 million naira, of course, such a sale, will not attract any tax at all. Even when it is above 150 million naira, if the gain is up to 10 million, if it is reinvested in the market within the period of 12 months, again, it doesn't suffer any tax. So the whole idea is to make capital stay in Nigeria. So with respect to the short-term end, talking about treasury bills, as I said earlier on, there may be need, maybe going forward, not immediately, to see how we can also introduce thresholds so that the small investors in treasury bills are also completely exempted, from the withholding tax. So it will only apply to those who are doing volumes. And another recommendation I also want to make here is that even with respect to the exemptions that we have in terms of sale of shares, when you sell shares, it says that you won't be taxed if you reinvested the entire money in the market, in other words, in equities within the same 12 months. I'm also saying that in the future, when I'm saying near future, not now, because it's not good to have these amendments, done very frequently. Otherwise, you send a signal of, some uncertainty. But in the future, government may also need to allow reinvestments even in other asset classes. In other words, if you sell and you make a gain of 10 million, for example, and you reinvest that in bonds, okay, or in some other securities. So that should also be allowed. So that's my way of recommendation. But essentially, what the law has done is to protect small investors, is to also, on the other hand, ensure that capital stays in Nigeria. So the person expressing the concern, the customer expressing the concern, should know that investment in bonds today, government bonds, whether state or federal, are completely exempted from tax.
Thank you so much, Professor Uche Waleke, and that was quite insightful, and I had picked up one or two things from your response. Mr. Folonsha, I will come to you right away, and after you, I will pose a very interesting question to Mr. Olufemi as well. Mr. Folonsha, I've got a customer here who is posing a particular question. He says, the reform raises the small company threshold and restructured parts of the tax framework. But many businesses are asking a practical question. Will this meaningfully reduce their tax burden and compliance pressure, or largely reclassify it? How should they actually really think about this in practical terms from an expert standpoint?
Thank you very much for that question. Just to add one sentence to what Professor Waleke has mentioned, is to emphasize the fact that when you talk about short-term securities, the withholding tax is also taken as final tax if it has to do with individuals. So savings account, fixed deposit that is not more than 1 year, they also come under short-term securities. And so when the withholding tax is deducted, it also does not suffer tax. Now, coming to the threshold for small company, just to restate what the threshold says, is that if your turnover is 100 million and below, then you are classified as a small company. Or your turnover is less than 100 million, but your asset, your fixed asset, is more than 250 million. I mean, is less than 250 million. Then you also qualify as a small company. Why the 250 is coming particularly for institutions that incur so much in asset before they start generating turnover as income. So if you have incurred so much in your asset to the extent that it goes beyond 250, even without turnover, you are no longer a small company. Now, the exemption that is available for those small companies is very deep, and we can see the impact of that from the rate at which a lot of informal businesses are getting formalized. The first is that some companies in that category are totally exempted from income tax. So if they make profit, the profit for such company within that threshold are exempted from tax. Number two, they are not also exposed to the development levy of 4%. Remember that there's now a new development levy which has subsumed the erstwhile marked taxes of education tax, Naseni tax, NITD levy. All of those have now been subsumed and called the development levy at the rate of 4% of assessable profit. Those are not applicable to small company. Another point is that they are not required to file VAT returns. They're exempted from filing VAT returns, except they so wish to join in the VAT return VAT regime. And you only want to join if you know you deal in transaction that allows you to take deduction for your input VAT. Okay, so those are very significant exemptions that are available for them. Again, because their turnover is far from 50 billion, the story around global minimum tax of 15% has nothing to do with them. So they have very significant benefit, and a lot of people have seen that I would rather incorporate a company and get this exemption, because as an informal business in your personal name, this same exemption is limited to whatever the state where you are operating designed for you under the harmonization scheme that is ongoing. So it's a very veritable provision that has been inserted into the law to encourage formalization, even though we know that there are a lot of formal businesses that tends to tag themselves as informal. But of course, this one has given them that basis to say, I am now a formal business. So for small businesses, the benefits are very pronounced. And so far, the CAC can confirm the drove of businesses that are informal that are now getting incorporated so that they can get the benefit of being classed as a small company. Thank you.
Thank you so much, Mr. Folorunshor. Customers and stakeholders who have joined, please continue to post your questions. We have a time to pick more questions from the Q&A tab. Please use the Q&A tab to post more questions to our panelists. They're here to enlighten us and give us more ideas and get us ready to implement the new tax law. I'll come to you now, Mr. Lufemi. You know, you are at the main implementation discussion of the new tax reform. I would like to ask you a question coming from one of our audience. It says, from an implementation standpoint, what does getting it right look like for a typical business under the new tax law? What would be your advice? How should we ensure that our customers get implementation right?
Okay, thank you very much for that question. Yes, it's very important to get implementation right, both for the taxpayer and even the tax authority, because even the tax authority don't want to start a new regime with enforcement. So getting it right means moving from reactive tax compliance to a proactive governance, both for, like I said, for the tax authority and also the taxpayer. So a business should first understand which taxes or what's the obligation under the law, what it is. So when we talk about obligation of a taxpayer, we start. So the taxpayer have two obligations. First of them is obligation as a taxpayer. That means you have the obligation to pay taxes on your income, or whether it's, you have taxes, some consumption, and some also business-like taxes. And you also have an obligation as an agent for tax collection, agent of government. So let me first talk as a taxpayer. You have the obligation to register and obtain a tax ID. This is clear that everyone must register and obtain a tax ID. You have the obligation to maintain proper books of accounts. You have the obligation to maintain accurate records of employees. You have the obligation to render self-assessment returns on either monthly, that's for VAT, and so withholding tax, which is an advance payment of income tax, or annually for income tax and development levy. And also, you also have an obligation to issue tax invoice. To issue a tax invoice, you also have obligation to make the tax payment as and when due through available channels, through the bank, through the e-channels, or other electronic portal that the government has provided for. As an agent, in addition to the above, you also have the obligation to charge and collect VAT on vatable supplies, except for persons exempt from this obligation, which Mr. Albert has clearly said for small businesses, and also on goods exempt. Also, you should, as an agent, you have the obligation to deduct withholding tax on payment made and remit the same to the relevant tax authority. So depending on the class of supplier, as a class of persons you're making payment to, and you deduct withholding tax, you render the withholding tax. So the withholding tax deducted from individual taxpayers. So when we say individual, we mean taxpayers who are natural person, who is an individual, or taxpayers who is an individual doing business, which are those we classify as either enterprise or people having a business name form of registration. You remit such tax, withholding tax deducted from payments to the relevant tax authority in a state, which is the state IRS. So if the withholding tax is being deducted from supplies made by a company, such withholding tax is to be rendered to the Nigerian Revenue Service. So that is also an obligation as an agent of collection. Also, you have an obligation to deduct pay-as-you-earn deduction from the salaries of staff and remit same to the relevant tax authority. So if you have employees, you are expected to deduct tax from on the pay-as-you-earn scheme from their salary. And and you are expected to remit these deductions you have made to the relevant tax authority. And the due date for that is the 10th of the month preceding the month of deduction, the month of payment. So for withholding tax, the 21st day of the month preceding the month of payments. Also, you are expected to make the tax payment as and when due through the bank or the e-channels. And also, these are the obligations. You also expected to obtain a tax receipt or credit notes. You are also expected to issue. So now, if you are the one deducting payment as an agent of government for deduction of withholding tax, you are expected to issue a tax receipt for the deduction to the person whom you have deducted from their payment. And also, if you are the one being so as an agent, this is your obligation. Also, you are expected to, when necessary, you can obtain your tax clearance certificate to also clear you of burdens that you have been able to comply. The essence of this, beyond compliance, it means embedding tax into your business decision, into your pricing, your procurement, your expansion schemes, your financing, and cross-border transactions. So you know there are consideration for taxes. You need to embed this into your business model and ensure that your compliance is top-notch. So in simple terms, right classification, right computation, right documentation, right filing as and when due, and right payment of taxes is what taxpayers should think about, and this will make them more compliant with the order of the day. Thank you. I believe I've answered that question.
Thank you so much, Mr. Olufemi. You actually did answer the question well. Please, customers and our audience, use the Q&A tab to post your questions. When you post them on the chat, I may not be able to pick them to ask our panelists. Please use the Q&A tab. That's the tab that I'm referencing for most of the questions. Mr. Olufemi, please, I need you to help an audience clarify something. It says, I would like to know about the 800,000 threshold of income tax for individual, that's personal income tax. It says, if somebody who invested in stock and bonds, for example, or somebody who invested in treasury bill, and the proceeds get credited into the person's account, would the proceeds that have been posted into the person's account breach the threshold, or would it be exempted? Or just help clarify how that is treated. If the person earns below 800,000 but has been able to save up to 100,000 and invest that in treasury bill, gets some interest on it, and the interest is now posted into his account, how would the tax authority treat that? Please, your guidance is required from one of our audience.
Okay, thank you very much. For such investment, this person, you said, is under the 800,000 taxable income, which is 0%. So in calculating the 800,000 now, the one for treasury bills, the tax would have been deducted even from the money before it's paid to the person. So that does not affect the computation of the 800,000. So he has already paid tax on that one, which would have been deducted. So it does not make the income more. It doesn't make the income more because it's in the bank account. So one thing is that the basis of calculating tax is not bank accounts. So every payment that goes into the bank account will be pruned. In fact, because we practice a self-assessment regime, you are expected to compute your tax yourself. So you are expected to declare your income yourself, and on that, tax will be paid. So the mere fact that you earn a T-bills, except that amount, well, in fact, that amount will be even. So one thing is that you're expected to compute your tax. You add that. By the time you add that to it, if you add that income to it, and it's still, if it's more than 800,000, tax would have been taken. That tax will serve as a credit, which you can use. If your tax, if you are more than the 800 after that. But if you're not more than, it still does not take, it does not mean, so we have to first calculate, ensure that you pull all the incomes together before that. But one thing is that the T-bills tax is always taken have been remitted as withholding tax. So after that, you want to know whether your income is beyond 800,000 or not. So we have to know. You have to pull all your income together. So I believe that should be clear.
Let me add to
Thank
that.
you so much.
Okay.
Okay, so the 800,000 threshold relates to your taxable income. And for every person, the taxable income is not your gross income, right? And it's even not your turnover. It's not the credit in your account. It is your taxable income. And taxable income is the income that are liable to tax, less the relief. Individuals are still entitled to relief. One, the pension contribution is deductible. Two, your health insurance contribution. Three, if you have interest on mortgage loan and you want to take a deduction for it, particularly if it has to do with your owner-occupier, you take it out of that. Four, if you have life assurance policy or a contract of deferred annuity, which you have contributed, particularly as it relates to your own life, right? You can take those deductions away from your total income. Now, in arriving at your total income, again, if there's any income that has suffered tax, which should not be subjected to further tax, you take it out of that total income. For example, the interest on fixed deposit, which is can be classified as short-term security. They are not supposed to be liable to further tax. So it is after you have taken those income, take out those relief, that you now start talking about what is the balance. Is it 800,000 or above? If it is above 800,000, the first 800,000 of that amount is taxed at 0%. The next one at 15%, and the graduate up to 25%.
Thank you so much for that additional clarification, Mr. Folonsho. Mr. Folonsho, please help clarify this question for one of our audiences. It says, I'm a salary earner and also run an SME. I have thin on my payee and also thin for my company registered as a business name with CSC. I literally fund my business with a loan from cooperative, monthly contribution, and savings. All accounts share the same BVN, including POS accounts and salary accounts. How do I go about paying my tax without suffering double taxation?
All right. So as long as it is not a limited liability company, both you and your small businesses, as the case may be, are supposed to be subjected to the same tax. The small businesses in their personal name are not liable to tax. If you run an Ojo & Co. or you have Abiola Enterprises that sells at Okeari, okay? So that is a separate source of business. The guy also said that he's also an employee. So there is another source of income, which is salary as a source of income, part of which will have proper tax at source, will be deducted by the employer.
Yes.
The business that he's running, he needs to prepare a small account. You don't even have to file prepare audited financial statement, except you are a limited liability company, right? So if you run a small business by the side, ensure you prepare a small account, even if it's inside the notebook, stating how much your turnover is, how much cost you have incurred in buying the item you are selling, how much other expenses you have incurred in generating that income, your rent, your attendants, if you have somebody that stays in the shop for you and all that, all of those will be taken out from your income. And then you now go to the PIT computation table, bringing your income one after the other. Number one, salary. Okay, you put it there. Number two, income from trading. After you have deducted your expenses, even if you use any asset to generate that income, you are also entitled to what is called capital allowance. Number three, you have a property and you are receiving rent, the rental income. After you have deducted your expenses of rent, of repair to the building, including capital allowance on the property. Because if you are running a rental business, in terms of property, the rent is not the total amount that will be subjected to tax. You are also eligible to take a deduction for expenses of repair of a tap, water rate that you pay, if you are the one that pay it, and all that. And then you arrive at what is called the accessible rental income, the accessible trading income, your salary income. You put all of that together to give you what is called your total income. All right? In your personal name, not in the name of XYZ, as long as it's not limited. Then you now take out your relief that I mentioned earlier. After you have taken out your relief that I've mentioned earlier, you have what is called the taxable income, from which you now take the first 800 at 0%, the next 2.2 at 15%, the next 9 million at 18%, the next 13 million at 21%, the next 25 million at 23%, anything above 50 million at 25%. So it's pretty straightforward. We need to keep record whatever type of business we are doing. It is not the transaction in your bank account that will be subjected to tax. It is what you prepare. Show the tax authority where each income is coming from. That does not mean you should now allow your account to be used in distributing money for your community people. All right? You will be at risk because you need to account for every inflow that goes into your account. And to say that this is no income, this one, they just say I should give my junior brother. That's a lot of complication you don't want to go into. All right?
Thank you so much, Mr. Folorunshon. Mr. Olufemi, I'll come to you again because this is an implementation question from one of our audience. It says, businesses often say the real burden is not just the tax itself, but the effort required to comply. What is being done to make compliance more efficient and less disruptive to small businesses? Mr. Olufemi.
Okay. The reform agenda recognizes that compliance cost matters. The cost of complying should be considered in reforms, and that is why there's emphasis on digitization. Also, simplified filing system, exempting some classes of business from tax payment. And so also making it simple for them. Integrated taxpayers account and also simplified account system. Also emphasizing on risk-based audits, clearer forms that make things easy, even simplifying the laws. All these are so that you don't need to employ or you don't need to take a very expensive consultant to help you decode the law. Also, reducing even the numbers of taxes. These are all indications that it tends to ensure that compliance is easy. Automating tax returns and payments. I'm sure you are aware that the NRS have continued to develop and modify the tax administration system to make it easier and friendly. The self-service helps also is to make compliance very easy and efficient. So the direction is towards filing, simplified filing, where data already submitted, where they are also reducing the multiple times of receiving requests. Automation will help to do this. So where data has already been submitted, of course, we can consolidate on that where different arms of need those data. And that is even one of the use of the tax ID too, makes harmonizing administration. So also the use of e-services, e-received, online payment, taxpayer self-service portal, like I have mentioned, and also help. We also have what we call the self-health systems in our offices. All these are to ensure that manual systems are being phased out, and automation is the key, which will help to reduce, to improve compliance and also reduce the cost of compliance. So these are some of the things that are being done to ensure that the burden is not just, to ensure that the burden is not about whatever we make it efficient is being done. Thank you.
Thank you so much, Mr. Olufemi. Prof, I will come to you now. I would like you to address, just give your view on this question. The decision to retain VAT at 7.5% was seen by some as the stabilizing move. From a market confidence standpoint, do you think that was the right call to keep VAT at 7.5%?
Yes, absolutely. That was the right call. When we were doing this, there were rumors that the VAT was going to be increased to 10%, 12.5%, and 15% because of the argument that Nigeria has one of the least value-added tax rates in the world at 7.5%. But the good news is that that was not changed. It was still left at 7.5%, and for obvious reasons. Number one, the elevated nature of inflation in Nigeria. If the VAT had been increased, of course, that would have gone a long way to worsen the inflationary, situation. Particularly so when you also consider the fact that there were also a few other things that were introduced as part of the reforms. Talking about the capital gains tax, for example, aligning it for corporates with the company's income tax from 10% to 30%, introducing or increasing the VAT from 7.5 to 10 or whatever would have been a huge shock on the economy. So I think it was a very good decision not to increase the VAT. As a matter of fact, the whole of these tax reforms, is important to note that government did not introduce any new tax. No new tax was introduced. And the focus really wasn't about revenues. The focus was to improve the tax, the tax environment. Of course, revenues will naturally increase by the time you increase the tax base, which of course is also what the reforms have sought to do: increase the tax base, cover the digital service area, and plug loopholes. Loopholes, particularly with respect to tax avoidance schemes. You know that before the implementation of the these new tax laws, a number of companies, particularly the multinationals, were engaging in tax avoidance schemes, what is known as profit shifting. That brings me to one of the questions I saw in the chat box. Somebody had asked, how will this impact people who are doing businesses abroad? That was one of the questions I saw. Well, through one of the things that has also been introduced now, the control of foreign companies rules, through the indirect transfer rule. I give an example. If you own a company here in Nigeria, for example, you have a company, ABC Limited, and the company has land in Abuja or Lagos, valued land. And instead of you to sell the land or sell the company, you go and incorporate another company in, say, Mauritius, or another holding company. And then you sell that holding company. Under the previous arrangement, under the previous tax laws, you will not be taxed on the gains you have made by selling the holding company because it's in a foreign land. But in our new law now, if you do that, it will be assumed that what you've actually sold will be the company that you have here and the land that you have here. Okay, so the indirect way of selling things now will no longer work. So the idea of profit shifting again, where you have companies either over invoicing to their parent company just to reduce the profit they are reporting here in Nigeria, Now, all of that, have changed. And that's also signaling to the world that Nigeria's tax laws are now very much in line with, global standards, and that Nigeria is open to, those who want to come in here to do genuine business. So that point must be noted. There is also the issue of minimum tax that was also introduced. Before now, it's also noticed that some big companies, multinationals again, we are not paying up to even 15% minimum tax in line with the OECD. So now the reforms have now said, if you are a company and your turnover is up to 750 million euro or 50 billion naira, as the case may be, you must pay up to 15% minimum tax. So if you are paying less, you have to pay a top-up tax. So that way, as I said, is also one way we are aligning with global practice. One way we are also letting international investors know that Nigeria is shouldn't be an outlier when it comes to international tax. So it is to that extent that it affects those doing business. Of course, if you're doing business abroad and you earn income abroad and you bring that income into Nigeria, that income is not going to suffer tax because it didn't make it here. Okay, so unlike before, again, so that's also what international people doing business abroad need to know. Once your income is made abroad and you bring it in, you're not taxed. Government is encouraging you to bring such money, into the country. So before I end, there's also something I saw here which I want to clarify. Somebody was asking, what's the difference between turnover? What do we mean by turnover? Because I think when Mr. Abbott was responding, he talked about threshold. And the question was, the threshold, is it 50 million or 100 million? I saw that kind of question. Okay, so that's because we have the 4 major tax laws that make up the Nigerian Tax Act. Okay, the Nigerian Tax Act 2025, you have the Nigerian Tax Administration Act, you have the Nigerian Revenue Service Establishment Act, and then you also have the Joint Revenue Board Act. Okay, so in one of the laws, you have 50 million. In another of the laws, you have 100 million. But the good news is that whenever you have such discrepancy, it's usually resolved in favor of the taxpayer. So the higher one, 100 million, is now the threshold for small businesses. And it's 100 million turnover. So somebody is asking, what is turnover? Turnover is just the sales. Okay, it's different from profit. To arrive at profit, you have to remove all your costs to get profit. Okay, profit is what is taxed. So if your turnover is not up to 100 million, that means any profit you make will be exempt. So the whole idea is to also encourage formalization, to act as a pull factor to lure businesses to formalize. That's why the incentive is there, to exempt them from no CGT. They're not paying companies income tax, they're not paying CGT, they're not paying development levy. All manner of taxes have been freed for this category of companies. So it's important that your customers recognize that once you have a company and the turnover is less than 100 million, you don't pay any form of tax at all. But you are encouraged to file your returns. You're encouraged to keep records, documentation records, to now show that this is the scale at which you're operating. So the whole idea is to encourage you to grow. Government will encourage you to grow, and eventually come within the tax bracket. So in a nutshell, to answer your question, it's good that the government retained the 7.5% VAT, that it was not increased. So our customers should know that it was not increased. And another thing your customers should know is that the VAT itself has been reformed. Unlike before, when businesses were not getting back their what is known as input VAT. Okay, now you can recover your input VAT, particularly for those who are, if you're dealing with some certain essentials like the medical essentials or education, any VAT you spend, you have to recover it. but you're of course not allowed to, pass it on. You're not allowed to charge VAT, but you're allowed to recover VAT. And that is why the part of the reforms now is to change the status of food, of medicine, essential food for that matter, from the current status. The current status is exemption, VAT exemption to zero rated. That's also what your customer should know, the difference between VAT exemption and zero rating. So now, those essentials are now under zero rating, no more VAT exemption. And zero rating, as I tried to explain, is a better arrangement because it allows you to recover your input VAT. Okay, so unlike the previous situation where you cannot recover your input VAT, again you can't charge output VAT because the commodity you're dealing with is VAT exempt. Thank you.
Thank you so much, Prof. Mr. Olufemi, I need you to clarify something for a customer who says, as an international employee and who the employer deducts tax from, how is he affected by the new tax law or the new tax rule? What should an international employee do in this case if he's a Nigerian but he's an international employee? Please provide guidance.
Okay. There need to still be further clarification, but I will assume some question. What it means by international employee, probably he lives in Nigeria, but is employed by a company abroad, and he earns money from employment abroad, but he resides in Nigeria. So if you reside in
Nigeria, one scenario.
You say? Is that?
That's one scenario.
That's one scenario.
That's one scenario.
Another
Can you also give another scenario where
you
can also give another scenario where he resides abroad?
Okay, I will explain both of that. So the first one, he resides in Nigeria, but probably he has an employer abroad. Maybe he does remote business, or maybe he consults remotely. Now, if you consult remotely and you earn income from abroad, at least the person paying you abroad will not charge you tax because you reside in Nigeria. You don't reside there, so they won't deduct tax from your money. Well, I know in some cases, maybe the US, maybe that can happen. But for Nigeria, once you reside in Nigeria, we practice a residence-based taxation. And if you reside in Nigeria, you will be charged, you have to pay your taxes in Nigeria. That's your income tax. And so whatever income you earn from that employment, once you reside in Nigeria, you are expected to declare such income and pay your tax to the relevant tax authority of the state where you reside. So that is one. That means you are a resident of Nigeria and you reside in Nigeria, but your employment is abroad. That is, you are still supposed to declare your income in Nigeria and pay your tax in Nigeria. Now, number two, which you said is a Nigeria but resides abroad and earns income abroad. Of course, that one is not in our purview. So if he resides abroad, earns his income abroad, he's charged tax abroad. Now, the only thing maybe he's talking about, because it's in Nigeria, maybe he now remits money back home. If remits money back home, you maybe send it to your account or you send to people in Nigeria. No, the money that comes to your account is not taxable. You are not going to be charging income tax on them. Aside that, if that money sits in your First Bank account and First Bank gives you interest on that money also will yield. That means that money is also working for you in Nigeria. The interest on that money will be charged to tax and not the money itself. So not that money which has been charged to tax that we are charging to tax. If that money brings further interest, brings further income, such it will be charged to tax. If that money is also invested in other investments, maybe you invest in T-bills, of course, the interest on them will be charged to tax. Or you take that money you decide to buy property in Nigeria, and that property earns income, such will be charged to tax. I believe these are the common two scenarios that you should have. If there is any other, I'm happy to clarify.
Thank you so much, Mr. Olufemi. Yes, you're right. I think it's also good to tell the customers that the tax on the interest is just withholding tax, which is 10%, and it only applies to the interest portion alone, and is a final tax. Once you pay that on the interest, is final. It's not used again. I have a question here, and that question is not for our panelists, it's for, it should be for our panelists, but let me ask. A customer is asking, I do not live in Nigeria. Why do I have to pay tax whenever I transfer funds to anyone from my Nigerian account if the money is 10,000 Naira and above? I believe what he's referring to is stamp duty that is charged. So please, Mr. Olufemi, clarify what is the difference in stamp duty and tax.
Okay, so we have different classes of taxes. We have transactional taxes, which are indirect taxes. We have some which are consumption taxes, and we have income tax. Now, when you say you do not live in Nigeria, what you're mainly speaking to is an income tax. So if you earn income, Nigeria does not have business charging your income to tax because you do not reside in Nigeria. However, if you consume in Nigeria, you live abroad. If you consume in Nigeria, that consumption is done in Nigeria, such consumption will be charged to tax. If you also carry out transactions such as transferring money from a Nigerian account to another Nigerian account, or even outside Nigeria, but the account you're transferring from is Nigeria, such is a transactional account, which is stamp duties will be chargeable on that Nigeria account because, of course, it's not an income tax. These are transactional taxes, and the rule of residence or where a resident does not apply to it because the money or the transaction, the services, or because if there is a dispute, what stamp duties is about is for it's on instruments. It's on instrument that is tied to those transactions. So, of course, the bank is going to issue a form of receipts for these transactions. And what stamp duty is about is that when there is any issue on those transactions, you are going to visit the law court, you are going to tender documents in evidence. Those documents can be admissible if they have been so charged to stamp duties. And so to that extent, those transactions were carried out in Nigeria with a Nigerian entity. And so if there is any issue, those issues will be also government will come in by the way of settling those disputes in our law courts. And that is the essence of stamp duties. Thank you.
Are you there?
I am, I guess, our host.
Host, come back.
No, I think Chike is frozen a bit. Let's just hold on. Chike, please go ahead.
Okay, looks like we lost Mr. Olufemi briefly.
No, you were.
No, we actually lost you.
You were the last one.
Okay. I
You're
didn't know I
welcome
was
back.
lost. Okay, thank you so much. I have a question from one of our customers who has said, under the new tax law, how does a Nigerian who works in foreign embassy, how does it affect the person in terms of income tax?
So you want me to answer or you want someone else?
Yes, Mr. Olufemi, please answer.
Okay, so Nigerian that works in the foreign embassy. So the way it is that one thing we should first know is that nobody is exempt from tax.
Yeah.
Nobody is exempt from income tax. Many people have said because they work in foreign mission, they are not supposed to pay tax. No. So what it means is that if a Nigerian works in foreign embassy, that embassy is seen as Nigerian jurisdiction. Now, I want to also, the first one, there is a first level, a Nigerian who works abroad in a foreign embassy. Okay, one of them is a Nigerian who works in foreign embassy in Nigeria. Okay, that one is a Nigerian,
Yes.
and it's on the soil of Nigeria. Is expected to pay income tax. Now, the problem we've been having before now is that the embassies have said they are immune from our taxes and obligation, which no. Now, because they are employer of labor, they are also expected to deduct and remit taxes of their employees. So in Nigerians who work there, if your employer does not do that, you are expected to self-assess yourself, declare your income, and pay your taxes. Please, if the employer does not do the pay-as-you-earn scheme, Nigerians who work in the embassy is expected to do that, to declare their income and pay their taxes, where your employer has refused to follow the pay-as-you-earn scheme. Now, the second class is Nigerians who work in foreign mission. Now, Nigerians who are Nigerians where they work in embassies abroad, or they work in Nigerian embassies abroad. Such persons are seen to still be working in Nigeria. That means the embassy is seen as Nigeria. So the the country abroad, whether a Nigerian who works in Nigerian embassy in UK now, the UK government will not charge such Nigeria to income tax in UK. So such person will pay tax to Nigeria. Now, such tax is now the embassy or the Ministry of Foreign Affairs that deploys such person is expected to remit tax of that person. And in that case, that is now remitted to the Nigerian Revenue Service rather than any state of residence, because the person does not reside in Nigeria. So that is the classification of Nigerians working in embassies in Nigeria or foreign missions abroad.
Okay.
Thank you so much. Prof, I'll come back to you now. Prof, I have a question for you. What are the implications of the reform for sectors that rely heavily on structured financing, such as infrastructure, real estate, and energy?
Okay, thank you very much. I think the best way to look at to approach that is to look at two key routes or channels, two key channels. The first channel is the development levy of 4%, which, just as Mr. Albert had said, consolidates the multiple levies that companies used to pay, whether it's a tertiary education fund, NASENI, police trust fund, IT fund. Now we have it as 4%. Now, part of that levy, part of that 4% is allocated to infrastructure. Some of these infrastructure that you cited. Now, the other channel too I want to identify has to do with the economic development incentive. There is the economic development incentive, which provides 5% tax credit on qualifying capital expenditure. So that's also where you have the real estate, coming, because the EDI on capex, covers, real estate and the infrastructure that you mentioned. And now, with regard to energy, of course, what readily comes to mind here, has to do with some of the taxes I mentioned earlier. We know a number of oil and gas companies. They are multinationals, and they also have subsidiary companies. So the minimum effective tax rate, of course, applies to them. And the issue of indirect transfer and control of foreign companies, also, will also apply to some of these companies. So essentially, is about providing clarity in funding structures, and that is what the reforms, have attempted to do for the three areas that you mentioned, whether it's infrastructure, real estate, or energy. So it's clarity, with respect to the funding structures. And I've just told you that many of these sectors will benefit from the development levy, and they will also benefit from the EDI, Economic Development Incentive, which wasn't there before. So that's positive. But before I conclude, Chike, if you permit, I have also noticed, yes, a few questions on the chat box I want to quickly react to. Somebody is asking, one of your customers is asking that for an unemployed person who relies on gifts, who receives gifts, will such gifts be, monetary gifts, are they also going to be taxed? Particularly if those gifts are going through the person's account? The answer here is no. Okay, the tax law does not provide for taxation of gifts as long as they are gifts. Now, another customer here is also asking that he says, if I invest in First Bank shares, if I buy First Bank shares, will I pay tax on my dividend? That's the question I saw there. If I buy First Bank shares, will I pay tax on my dividend? Of course, when you invest in a company's shares and the company makes profit and declares dividend, the tax that is attached to it is withholding tax. That's the 10% withholding tax. But when you sell those shares and you make profit, you make a gain, okay? You bought First Bank at 20 Naira and you're selling First Bank now at maybe 25 Naira, okay? There is a capital gain of 5 Naira, per share. Now, on that gain, again, you're not going to pay any tax. There's no capital gains particularly for corporates. Remember, with you have threshold where you don't pay anything at all. So except where the disposal, where the sale of shares you have made is large, up to 150 million, that is when you can begin to talk about paying any capital gains tax at all. And capital gains tax for individuals, have now been aligned with your marginal tax bracket. Capital gains tax used to be 10%, whether for individuals or companies. But what the law has now done is to say, for companies, capital gains tax is now 30%. And for individuals, capital gains tax will now depend on your marginal tax bracket. Okay, those graduated rates that you have as your personal income tax rates. So it's no longer the same with that of companies. But to answer the question that he asked, you pay withholding tax when withholding tax is taken upfront before the dividend is given to you. When you now sell those shares, as long as you are a marginal investor, you are not selling volume, you are not also going to pay tax. The law protects small investors. It's only when you are doing volumes, 150 million, as I said, that you'll be taxed. Even at that, if you reinvest the 150 million within a 12-month period, again, you are completely exempted from tax. If you make the gain of 10 million and you reinvest the money, you are not taxed. And it's important to mention that before you talk about gain at all, that's the beauty of the law. The law allows you to remove every cost you have incurred, every transaction cost you have incurred. You deduct them before you can talk about gain. The law has also said that if you sell shares, securities, and you make a gain, you sell First Bank, for example, you make gain on First Bank. You sell another security, another share, you make loss. The law says you can use the loss you have made to offset, first of all, use it to offset the gain that you have made before talking about tax. So by the time you use the loss and offset gain, you realize that you're not paying any tax at all. So people should know this. And that's also brings me to the issue of records keeping documentation. Today, you have many people that have bought shares a long time ago, and they are not keeping track of the cost of even the shares they are buying. When you don't have records, it's difficult for you to compute your capital gain, okay? And then, before you can talk about tax at all. So capital gain is different from withholding tax. Capital gain is 30% for companies. Withholding tax is 10%. Dividends attract withholding tax. the gain you make when you sell security is what attracts capital gains tax. Again, as I said, that depends on the threshold. These are some of the ones I noticed chat box. Thank you.
Thank you so much, Prof. Mr. Folosho, please, I would like you to help clarify a question from one of our customers. He says, I'm a pensioner. I receive and live on my pension income, but I have a small business by the side to help augment that pension income. What is it that is expected of me with respect to the new tax law?
Okay, thank you very much. Before I answer that, because it appeared to be the easiest question so far, let me just make some clarification on some of the points that have been raised, starting with disclosure of people receiving gifts. Yes, as already mentioned by Prof, gifts are not liable to tax in Nigeria. That is, if it is a pure gift. Gift is what you receive without any consideration or part consideration or for any benefit. You have not given anything for it. All right. So we need to be very clear about what gift is. And of course, there is also a question around unemployed person disposing of a property. Again, the issue around capital gains tax, we need to be able to clarify it. There's really not nothing in the law that talks about capital gains tax per se. It is income tax. It depends on who is selling. If a company is selling an asset or selling anything, you make income and is liable to corporate tax at the rate of 30%. If an individual disposes of any asset, you generate income, whether you call it capital income or revenue income. Now, I mean, it is the same threshold. You go to the taxable of rate. The same way you tax normal revenue income is the same way you now tax capital income. So, because there has been controversy as to, yes, if you go to the law, there's no capital gains tax. And true, there's no capital gains tax.
That's fine.
Income tax. And the rate applicable is the income tax rate. So I think that clarification is very important. I will come to the question, but I have a number of, I'll just be fast now. Somebody said I'm an unemployed and I'm disposing property. Yes, if you dispose property, you make income from it, you'll be taxed like anybody that has made income. If that is the only income you have that is climbing the taxable, it means that the income, the first 800 of that income will be exempt before you go into the next 2.2, before the next 9 million, before the next 13 million, 25 million and above. So that is very straightforward. When you make income, you pay tax. If you do, whether it is not about whether you are working or not, it depends on whether you have earned income. Then the last question you raised about structured finance, talking about real estate, power, oil and gas, it depends on how what structure you have put in place in raising those funds. There are multilateral financing, there are institutional finance, there are funds you raise through bonds, through debenture, through foreign borrowing, and all that. And of course, when it comes to foreign borrowing, it depends on which institution. Are you borrowing from IFC? You are borrowing from Afrexim or from just any other bank abroad that is not recognized as an institutional lender? That determines the type of exposure that you fall in as an individual banker, a business. So you need to be very clear where your money is coming from. Some of this money are routed through the bank as an on-lending facility that are routed through the bank. It also determines whether the bank has obligation to source deduct withholding tax on the interest, to source deduct withholding tax on fees that are associated with structuring the loan. And of course, the issue around stamp duty also is very important that is also clarified to ascertain who has the obligation. At one point, the fact that a facility is not liable to withholding tax on interest does not exempt such facility from withholding VAT on the fees or stamp duty on the instrument that has been put together, to raise that fund. Those are very critical areas that customers need to watch out for. And all of these costs are going to be passed on to the customer by either the bank that is on lending to them or whatever the case may be. All right. So I think that is very important. Again, the issue around pensioner earning income. if you're a pensioner, your pension income is exempt from tax. And that is very straightforward. It's not liable to income tax, all right, as long as it is within the Pension Reform Act, okay, and not that you just decide to pay yourself once in a while, pay yourself money, and you call it pension. If you want to pay gratuity, it has to be structured in a proper manner and approved as provided by law. So if you're a pensioner and you have income by the side, okay, again, we need to look at the threshold. Is that income turnover up to 100 million? If not, you are not liable to tax. If it is above 100 million, then we'll start ascertaining what is the income you have generated, okay, in terms of turnover. And then we'll take away the expenses before you ascertain the income. If it's a limited liability company, of course, corporate tax will apply if the turnover is above 100 million. If you are a pensioner that is doing it in your personal name, in your locality, all right, as an individual, personal income tax becomes liable depending on what exemption has been provided by the specific state. Remember that each state is now harmonizing with the federal law. Okay, some of these federal law are applicable in the state, but states are also domesticating some of these provisions to apply to their individual resident. I know we have said the exemption for corporate now is if your turnover is 100 million and below. For some states, they're looking at 12 million. That if you are a trader, okay, and your turnover or your profit, your income is not more than 12 million, or your turnover is 12 million and below, it will not be taxed. Some of them have also said under the harmonization that specific income are totally exempt. If you are a roadside plantain roaster, or you sell using wheelbarrow and all that, there are categorization, all of which are supposed to streamline and reduce all the incessant taxes or the nuisance taxes, that are all over the place. Okay, so you need to know exactly where you are. You are a pensioner, yes, your pension income is not taxable. You have other sources of income. What is the threshold? Are you doing this business on the other side or by the side in your personal name or in the name of a company? If it is in the name of a company, we'll look at the threshold for exemption for company. If it is your personal name or in your children's name, as the case may be, remember again, like I said, if you are not limited, then it is you as an individual that will be subjected to tax. Whether you are doing it in Ojo and Co. enterprises, XYZ and Co. As long as there's no limited there, it will be taxed in your personal name. I think some of these clarifications are critical, and if I run through some, I've been trying to answer some of the questions online. The first
Thank
one
you.
says that.
Sorry, Mr. Folon, just a quick. I would like you to, because I see some trend of questions on the Q&A tab. Yeah. Please help clarify just broadly some of these things I'm going to mention. One, would somebody's account be taxed? This question is coming from most people from the diaspora. They're still confused on if I have money if I remit money, would it be taxed? Please clarify that, what that means for them. Also clarify what, in the eyes of the tax law, what a small business is. Just those two broad clarifications will help some of our audience. There's several questions around that.
Okay, quickly, tax is not on your account balance. Tax is, income tax, like Olarinde clarified, income tax is different from transaction taxes. Transaction taxes has to do with getting involved in any transaction, whether you are resident or non-resident is irrelevant. But when it comes to income tax, it has to be your place of residence. If you are abroad, you don't have a place of residence in Nigeria, except you have a place where you derive income from. Okay, the fact that you are even abroad and you derive income from a particular source does not mean that the tax is payable to that source. You pay it to the federal government if you are not resident. And that is the provision of the law. Okay, but if you have a property in Nigeria, but you are based abroad, right, you will pay tax on that rental income because the source, when it comes to taxation, it is the authority where the source of the revenue or the income is that taxes first before start talking about where the person is resident. So whether you are resident or not, the source will tax you first. So if you are abroad, you have a source of income, the income is taxable first in Nigeria. You will still declare it in your books when you are filing your return abroad. And then when you file those returns, you will also make claim for the tax you have paid at the source of generating that income, so that a relief, which we call double taxation relief, can be granted to the person. All right, so specifically, bank accounts are not subjected to tax. All those taxes they are calling income tax, they are not tax. They are not income tax. One, we have EMTL levy, which is stamp duty, which is applicable to the transferor, at the rate of 50 naira if the sum transferred is above 10,000 naira. Okay, 50 naira from the transferor. And of course, if you transfer to yourself within the same bank, there is no 50 naira charge. But if you transfer to yourself in another bank, two banks are involved. Like Olanide explained, stamp duty is just a duty that is paid so that where there is dispute, the instrument involved in the transaction can be given in evidence in a court of law. And of course, they have now turned it to, not turned it, is also have the objective of revenue generation. So we should clear our mind. No bank has been authorized to tax anyone other than transaction taxes that they have obligation to. For example, a bank that has helped you to transfer 50 million will charge you transfer charge. On that transfer charge being charged, which is an income to the bank will also charge VAT for the service they have rendered. Okay, there is a VAT of 7.5% on the bank's fee that they have earned. So you will see three charges now. One is the 50 naira for the stamp duty. Two is the bank's fee, commission on turnover. Three is the VAT on the fee, which is to be remitted by the bank to the tax authority. And those are very generic, normal transaction charges and taxes that must be remitted by the tax authority. Number two here you have asked is the issue of small business. Again, when we talk about small business, two contexts. One, as a limited liability company. Two, as a business that is not registered, okay, which we call the informal sector. And when you talk about informal sector, we are saying they are not incorporated with the CAC as a limited liability company. And the taxes of those informal sector rest with the state where the owner of the businesses reside. So for the one that are limited liability, the threshold is 100 million and below. When your turnover is 100 million and below, then you are classed as a small business. Or you don't even have turnover, but you have get involved in transaction or asset that is as huge as more than 250 million. As soon as you have incurred expenditure on fixed asset that is above 250 million, whether you have turnover or not, you are no longer a small business. This was brought in specifically for oil companies that run for a few years before they even start seeing turnover. Meanwhile, they are drilling, they are incurring expenditure on casement, on cement, and all that, which they do use for their development, either for the seismic survey, whatever they are doing, and they have not seen income. So for those, they are incurring expenditure. They cannot be classed as small business because the expenditure incurred is huge. They should be recognized so that they will be involved in VAT remittance. They would have to deduct withholding tax for people that are dealing with them and all that. All of those which are not compulsory for small businesses. So I hope that's clarified. The other question.
Thank you so much.
Quickly, sorry.
Go ahead.
Is the issue around, I have a long list of questions somebody asked here. Is construction of a building taxable? Who pays the tax? The one building, the owner of the building or the contractor? Where is the payment being made? You are constructing a building, okay, right? Maybe it's even, assuming you want to even sell it later or you want to live there. The taxable event there is the fact that you are, if it's an individual, see, an individual ordinarily does not have obligation to deduct withholding tax, okay? Because they are not recognized as an agent of government. It is only corporate body that can deduct withholding tax. So if I'm building my own house now, I can just be giving my contractor money. I can't deduct withholding tax because I can deduct and not pay, right? So, but in that situation, the contractor that is building the house for you has an element of income in the work he's doing. So if it's an individual, the contractor must file his own return as an individual, just like any individual, ascertain how much income he has made from that transaction. If you deduct withholding tax on the total sum as an individual, the withholding tax may end up being higher than even the income the guy has made. All right? But if it is a company has obligation to deduct withholding tax from the contractor's money, remit it on behalf of the contractor. The contractor is eventually going to file his own return. The amount you have remitted on behalf of the contractor will be used to offset whatever tax he has. If the withholding tax is higher than the income he has made or the tax that he's liable to pay, then he's eligible to claim refund. That is for a limited liability company. For an individual, you are obligated to the state where you are resident, and you have to provide details as to whether you have made money or not. Another question here says, what are the tax implications and disclosure requirements for resident who has been unemployed for several years but relies on monthly stipend? I think Prof has already answered that. If you receive gift is not taxable. Whether the fund is coming from abroad or from local, the money is coming to you for your subsistence. You have not rendered any service to receive those money. If you have rendered service, then we'll take it as income. But you have just received a gift. Therefore, it is not liable to tax. If an employee individual sells landed property, okay, I've answered that. For a remote worker earning USD, what is the legal procedure for converting foreign income for tax filing, blah, 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 the official exchange rate, or you can even, as far as federal is concerned, when the transaction is in US dollar, you have obligation to pay the tax also in US dollar. But for some states, you can pay it using the official exchange rate. Why can't people who are not paying rent, but are paying land use charge or tenement rate be accommodated in the rent relief? Now, this is rent relief that is applicable to individual, who has paid rent, employees who has paid rent. The rule for the essence of the rent relief is for you to disclose your landlord so that your landlord can be subjected to tax on the rent you have paid to the landlord. So it is not a major relief per se. The maximum amount claimable is 500,000 regardless of how much rent you pay. So it is a percentage of the rent or 500,000 naira maximum. And so if you have not paid the rent, you want to convert land use charge to rent. Okay, land use charge is the responsibility of the owner of the property. So if as a tenant you pay it, you are eligible to claim it from the landlord. All right, and the landlord can use it as an expense in reducing his rental income that is subjected to tax. I hope that is clear to so many of our people who have read that question. Thank you very much.
Thank you, Prof. Once again, customers, please post your questions on the Q&A tab, not on the chat. Ms. Olufemi, I would like you to clarify a particular question. Just from your general view, given that some aspects of the new tax law are still being clarified, how should businesses approach areas where guidance is not yet fully settled without taking an unnecessary risk?
Oh, okay. Sorry, I was muted.
Yes.
Well, you say so the first thing, the law itself is an instructional document. The law itself is the primary document which everyone needs to follow. Now, what the tax authority just do is that the tax authority try to simplify for compliance reason. So the tax authority try to produce what we call guidance notes, information circular, public notices, and other guidance to help simplify compliance. So we can also ensure that we look for professionals around to support. In fact, this is one of the reasons why we always yield to this kind of call to speak to taxpayers. So what we are saying is that tax individuals or persons need to, we are providing different notes, and so they can always oblige themselves or be available for tax education system like this, and also look for people enlightening around them to help them, because education is key. You need to be educated about anything you need to comply with. So, but I want to say there are guidelines that are coming up. They're still going to, it's being finalized, and it's been finalized, and we hope that it will come out very soon. In fact, they've been drafted. We have a whole lot of them, more than 30 of them. They are soon going to be released. So very soon, taxpayers can wait for the guidelines that is going to be released by the Nigerian Revenue Service.
Sorry, can I also respond to this? Because he has spoken from the tax authority's point of view. Those of us that are taxpayers and representing taxpayers, this is a very critical question you have asked. And of course, the laws are new, and they have been written in very simple and plain English language, which everyone should be able to interpret. Okay, so whatever guideline they are issuing is just a guideline, you know, and they have always disclaimed those guidelines themselves in certain situations, right? So which means your own interpretation, your legal interpretation, your layman interpretation is what you take to the bank. I mean, that you walk through. Again, I must also say that there has been delay in issuing those guidelines. The law is almost half a year through, and he's still talking about drafts, that's a pile up of guidelines. So clients are under pressure, particularly the issue around commencement of some of the provision of the law is still a major issue to be determined. Okay, and taxpayers have interpreted them on the basis of their understanding. So if after I've done my own interpretation, which I believe is my own position, which I can take to defend in a court situation, I don't believe that a guideline can now come 1 year after to say that what I have done, I have to reverse it, or I'm being forced to do only the interpretation of the tax authority. That will not work. All right. So each tax authority now have obligation to educate their taxpayers. The states are individually issuing small guidelines. Lagos State Internal Revenue have issued some guidelines. Even whether you complain about it or not, it is a guideline, and it has given an exposure into some areas. We expect those guidelines to be out so that debates like this can also happen, because whatever the guideline says is not final. It is the law issued by the federal government, passed by the National Assembly, and made available and gazetted is what individual and companies will utilize. We want to use this opportunity to thank First Bank for bringing this up, and the fact that the Nigerian Revenue Service should quickly come up, because a lot of issues are still neither here nor there. I won't say more than that. Thank you very much.
Thank you so much, Mr. Fonosha.
Sorry, before we close on that, I would also like to inform taxpayers that the law also provides for provision for advanced ruling and advisories that allows taxpayers to seek clarification on treatment, which is specific to them, or treatment of specific business, and the Nigerian Revenue Service will respond. I understand the point of Mr. Albert raised, and I want to still assure that we're working on them. But taxpayer can seek specific custom advisory and ruling, which we will give. Thank you.
Okay.
Thank you so much, Mr. Olufemi. Mr. Olufemi, please, I would. Some of our customers are asking this particular question. Help clarify the difference between VAT and withholding tax. That's one.
Okay.
Two,
okay.
I would like you to also throw additional details on this bank account turnover. I have a question here that says, I'm a procurement officer in my company. I pay my tax through the employer deduction on payee. I'm always giving money to petty cash to do some purchases on behalf of the company, and that money gets credited into my account, and it gets up to 200 million in terms of my bank account turnover. Will I be taxed extra? Please, I want you to use that to clarify the difference between turnover of a business and turnover on the bank account, and what's the tax implication, and also help clarify the difference between VAT and withholding tax. Thank you, Mr. Olufemi.
Okay, thank you very much. For difference between VAT and withholding tax, the first one, the withholding tax is an advance payment of income tax. So, because government, because income tax is a tax you pay, a tax you pay on your income. Now, if you are a salary, let me say you are an employee earns salaries. Now, you are naturally supposed to pay tax on your annual income. Now, you're supposed to pay tax on your annual income, but there is a scheme which has been developed because you do not receive annual tax, your annual income. You receive that annual income on monthly basis. Now, government now develop a scheme that since that money is coming on monthly basis, there should be a deduction from that money. The scheme is called Pay As You Earn. That Pay As You Earn scheme is a withholding tax scheme. So you deduct. However, the one that is very common that people call withholding tax is the one we call deduction at source. And that deduction at source is also where you make supplies. Now, that supplies, or you enter into a contract, you do majorly contract, and you earn money, you earn income, which naturally is supposed to be taxable at the end of the year after your annual accounts. But because someone is making that payment, government introduced what we call a withholding tax, that when such payment is made, a withholding tax should be charged on that payment as an advance payment of an income tax. Now, once that payment is charged, that tax is charged, the person can use that tax that is deducted from his payment to offset part of his income tax at the end of the year. So withholding tax is an advance payment of income tax. Now, and that is chargeable by the person making payments. It deducts it from the payment of the person is paying, whether he's paying for a contract, he's paying a supplier for a contract. That is what withholding tax is. Now, VAT is a transactional tax. It's a consumption tax. Now, if you as a supplier, that same supplier, let's say it's the same scenario, First Bank contracts, let me say, Professor Uche to provide a service for First Bank. Now, when First Bank is paying Professor Uche, the First Bank will deduct withholding tax from the payment, maybe consultancy payment, from Professor Uche's money. That is withholding tax. Now, Professor Uche, also when he's supplying First Bank, Professor Uche will raise an invoice to First Bank. Now, on that invoice, the service of Professor Uche, the service that Professor Uche is rendering to First Bank is chargeable to VAT. Let's say it's a consultancy service. So services, because that's a transactional tax, First Bank is consuming the service of Professor Uche, now a consultancy service. So it charges VAT on that service. So that VAT is expected to be paid by First Bank to Professor Uche. And Professor Uche remits that VAT to the Nigerian Revenue Service. Why First Bank remit the withholding tax they've charged to the Nigerian Revenue Service on that consultancy? But if Professor Uche was an individual which is, I've explained earlier, that withholding tax will be remitted to the state where he resides. So that is the difference between VAT and withholding tax. So VAT, once it's paid, that one you are supposed to it's on transaction, it's on goods and services. So while withholding tax is on all forms of contracts. And so it's not the same party that pay the two of them. So I believe that is clear.
That is clear.
The second question is say bank turnover and petty cash. Now, let's say you are someone that receives petty cash from your company, and what it means is that you probably help run some errands for your company. Your company would have booked that amount as an expense. which they incur. And now it's expected that that person will also come back with invoices and all documents of how they incur that amount. And when that person was incurring, most of the time, he will be receiving those invoices in the name of First Bank. Or sorry, let me use First Bank again. First Bank commission one of his staff, let's say you now, to organize a program, and you are supposed, and First Bank say, okay, because you will probably be dealing with laborers and low-end workers, take this 1 million naira which you can spend, and at the end of the day, you expense it by way of invoice. Most of the time, you go to town and say, please, when you give me invoice, write First Bank, write First Bank. Documentation matters a lot too. So at the end of the day, you return that to First Bank. It shows that that expense was incurred is by First Bank, and in your account. So of course, you will also clarify when you are making up your account that this is not an income to you. These are reimbursed, either reimbursable or some petty cash. So it's like I said, what you do in your own income tax declaration, you also have to declare. So the strength of your documentation helps to protect your exposure to taxes. And so such is not going to be classified as your turnover for the tax purpose. And that is why those documentation will help you clarify that these were things I did on behalf of someone. They were not my income, especially as an employee of that organization. So I believe that is clear.
Sorry,
sorry, before you, there's one notion that a lot of people have been asking. Someone who asks about is a pensioner. I used to tell people that the tax exemption is not to a status. It's on income. It's income that we tax, not really by income of persons. So when you say pensioner is just because you receive a pension income. It's the pension income that is exempted. However, if you're a pensioner, you have mega plazas. You are not just a pensioner, you are a businessman. So it's the business income that will be taxed. So the name pensioner is not something that is the person's name. The income from pension is what is exempt, because people ask this kind of question, and I think someone say I'm an unemployed person. Unemployment is also not just a title, or it's not you are unemployed, but you have buildings. When you earn income, or you have investment, when you earn income from those investments, the income there will be charged to tax. Thank you.
Thank you so much, our panelists, and thank you, our customers, for joining and having patience to listen to our expert panelists. At this point, we'll be drawing the session to a close, and we'll thank our panelists. I'll give each panelist one minute to quickly do a final talk. So I will start with Mr. Folorunso, just 1 minute to give 1 or 2 additional guidance or advice, or any area you would like to our audience to get more input into. Thank you, Mr. Folorunso. Just in 60 seconds.
Okay, thank you very much. My time starts now, right? Okay, so I wanted to make some clarification on what Olarinde spoke to, which is the issue of the person that claimed to be having a reimbursable, and the company pays him almost 200 million from which he spent. That is very abnormal, and it will be difficult for such a person to be able to clearly defend such inflow into his account. When it's like you are running the company now as if you are the company account. One should not allow his account to be used for such transaction. It is clearly abnormal. So, in summary, the tax law has come to stay. It's already in existence now. Like I said, clarification is required from the tax authorities. We can see that states are also harmonizing, so that particularly people are worried around these nuisance taxes, particularly. And so there is hope that by the time the productivity of this federal reform law is getting to the state, some of these nuisance taxes will disappear automatically as they are harmonizing the taxes they collect now to for each state to align it as being coordinated by the Joint Revenue Board. But of course, clarification will always be required, and it is advisable that you must ask those who understand so that you don't be on the wrong side of the law. Thank you very much for this opportunity, and thanks you.
Thank you so much, Mr. Foronsha. Prof,
okay, thank
60
you.
seconds, final thoughts.
Yes. Okay, thank you. Yes, I was going to respond to a question I saw here. The person is asking, if I buy a land for 20 million and I sell it at 25 million, what type of tax am I going to pay? Of course, if you buy at 20 and you sell at 25, you've made a gain of 5 million. So what you are now required to do is to reduce the cost of selling the land. You use it to reduce that 5 million, that gain. So it now gives you the final gain. So if that gain is, by the time you reduce it and you get like 3 million, for example, you now put it on your tax table as an individual. If you put it in your tax table, the first 800,000 will be tax exempt. The next one, of course, will now be taxed at 15%, okay, which is the next tax bracket. So you're taxed on the gain. Another thing I need to say before I wrap up is your customers also need to know that the tax laws have provided for what is called the tax ombudsman. We didn't have it before. Tax ombudsman is an office that is there to attend to all taxpayers. So if you're a taxpayer and you have issue with the tax authority or any form of dispute or issue, the tax ombudsman is there to assist. And this office is set up in all the states of the federation. And from what we hear, you don't even need to go there. A simple phone call to that office will help you clarify whatever issue that you have. So once again, I commend First Bank for putting this together, and it should be from time to time is something you should put up. It shouldn't be a one-off event. Thank you very much for the opportunity.
Thank you so much, Prof. Mr. Olufemi, final thoughts, 60 seconds, please.
Thank you very much for the opportunity to be on this call. I would have said it's rather late than never because of the time we were hearing taxpayers saying a lot of things about the banking and deductions. And thank you. At least this will clarify a lot. And yes, we want to also implore Nigeria. First thing is to understand that this tax reform is actually to make the tax system better, make it a fairer system, and provide utmost transparency in the tax system. And so Nigeria should be rest assured that the times is for a better times. And we are available to partner to provide more clarification whenever it is being sought from us at the Nigerian Revenue Service. I say thank you once more for inviting us onto this call. I didn't hear about the issue of 200 million for petty cash. That's actually outrageous. And whoever is doing that should be careful. I use an example of 1 million because I believe that is what is fair. And everything you say, like I said, you must prove. You must prove very well. Like when somebody asks of gifts, he said, oh, all his income is gifts. If you are receiving a gift of 200 million, you may need to also be able to come and prove that it's truly gifts. But thank you very much for the opportunity to clarify some of this issue.
Thank you so much, dear panelists, and to our customers. Thank you for joining us. The recording of this session will be hosted on our website, and you have an opportunity to refer to it. Thank you so much, and thank you, our panelists, for joining us today. Thank you and bye.
You're welcome.
Thank you so much for that wonderful taking of all the questions that have been coming in. I was just wowed. We had over 300 questions. and there's absolutely no how we'll be able to answer all of that today. Just because we respect the time of our customers, we would not want to keep you here longer than necessary. 2 hours was the target time, and we've already overshot that by 11 minutes. So we'll just want to say thank you so much for all that has been discussed. The new reality is already here with us. Whether you're an individual earning below 800,000 or less annually, or you are now happy that you are totally exempt from the new reality of tax payments, or you are a small business who is doing less than 100 million, and definitely who does not have assets of over 250 million, because that would move you into the next level of business, which is no longer small. Or you now know that FIRS has been changed to Nigerian Revenue Service, signaling a shift towards service-oriented agency and not just what it was before. Whatever it is, it's obvious that the economy, the goal, is shifting from taxing investments, production, to taxing consumption and returns. And in this way, formalization is very key. Even if there's nothing else you've gotten out of this webinar, it is to ensure that your businesses are formalized. In that way, you can enjoy the benefits that accrue to this new reality. And on that note, I would just want to say another big thank you to all the participants that have joined, and especially those that have led us through this very wonderful session, starting with the opening remarks by our able CEO, Olusegun Alebiosu, who gave the opening remarks, and our wonderful, very elegant Chief Economist, Chinwe Egwim. Then we couldn't have done it any better without Chike Ozoma, who is our head of strategy and corporate development, taking us through all the questions with the panelists and the three musketeers, like I will call them, very, very knowledgeable and wonderful men who have taught us a lot on taxation. In fact, this is like a master class. Thank you so much, Mr. Albert Folorunshaw, who is the managing consultant of Creston Pedabo, and Olumide Olarinde, the head of Fiscal and Tax Reforms Division of the Nigerian Revenue Service. Your contributions were very valid. And our very able Prof. Uche Owaleke, who is the Director Institute and the #1 prof of the capital markets in Nigeria. He's the Director of Capital Markets Studies in Nasarawa State University. Thank you so much. Let's give it up for these three very perfect gentlemen who have given us a wonderful afternoon. Thank you so much for joining. We appreciate you. And like it was said, we will be hosting the recording on our YouTube channel and on all our social media channels. So keep following us and you will definitely get to see the recording. For the questions, those that were answered, we thank you for putting them through. But for those that were not answered, we'll look for a way to compile them and also do the needful. Once again, have a very good afternoon and thank you for joining First Bank.